You have likely heard of bonds, but not that many people really know what they are. Bonds are normally grouped together with stocks and other investment vehicles, but they are not normally looked at alone. At its core, a bond is just a piece of debt, or an IOU, so it can be looked at like a chunk of a larger loan. These equally sized chunks are called bonds, and they individually follow the larger loan's terms. For every bond offering, there will be a set amount of bonds issued, a set length, redemption value, and an interest rate, as well as a payment method for that interest. With bonds, interest is either paid in one chunk at the end of the bond when it matures, or paid over time as interest-only payments. The main benefit of bonds is that they are designed to be traded, so they are much more liquid than loans for the issuer. Because of this liquidity, bond issuers hold less risk creating the bonds, as they can easily sell them. This lower risk also allows issuers the ability to offer an interest rate much closer to the actual market rate for the borrower. They can also offer the interest for a longer period of time, as the bond price on the market will compensate for changes in the interest rate. So overall, bonds are a great tool for making loans more liquid, and everybody should just issue bonds instead of loans. But just wait a second, there is an issue, and that is regulation. Let's look at a fiat bond market example. Let's just say a decent-sized company owner likes bonds and wants to issue some, as he feels it's a better form of debt. He knows his bond offering has the right amount of risk and reward, and knows some bond investors who would purchase them. He applies to a commercial bank for the bond offering. He is then instantly declined. This is because bonds are regulated as tradable securities in the fiat market, meaning many regulatory requirements need to be met before they can be offered, which basically limits the bonds to governments and very large companies. And because it's the fiat world, protectionism is king, and the process has many middlemen and fees in between the borrower and the investor. Commercial banks are allowed to create the bonds, and then later through two brokerages and the exchange itself, investors can then buy them. And throughout the process, there are many regulations, contracts, fees, taxes, and other expenses that cut out value from the end bond. So because of these monopolies, including the government's monopoly on money, this has been the only way to work with bonds. Until now, with BTCpop's peer-to-peer Bitcoin bond market. BTCpop is a platform which enables borrowers and lenders the ability to create a bond transaction, which is quite similar to its peer-to-peer loans. Borrowers work to prove their creditworthiness through verification and slowly building a solid online reputation. They can then post their bond offering on BitPop's open market for investors to consider. To make their offer more appealing to investors, borrowers can even add collateral in the form of specified peer-to-peer shares or altcoins held by BTCpop until repayment. The peer-to-peer investor market then views and determines if the borrower and the bond are a worthwhile investment. If they decide that it is, they simply purchase the bonds with Bitcoin. If all the bonds are purchased, the bond is then activated. The borrower will receive his Bitcoin and the investor their bonds. Investors are then free to hold the bonds and receive interest on them, or trade them on BTCpop's online bond exchange. When it comes time to pay back the bonds, there is some flexibility compared to loans. With a loan, the repayable amount is broken up into equal payments of principal and interest. So as payments are made, the borrower's access to the original borrowed amount is lowered every payment. So by his last payment, the borrower only has access to a small amount of the original Bitcoin borrowed. With bonds, there are different options. One option is to simply pay back the bond and the interest all in one shot at the end of the bond when it matures. This benefits borrowers that need maximum access to borrowed coins. And it also benefits investors as they get the most interest as it's accrued on the full amount. Another way for bonds to work is for interest-only payments referred to as dividends in regular intervals until the principal is all paid back at the end of the bond. At BTCpop, you can do bond versions number 1, number 2, or even a variation of both if you desire. And borrowers are even able to buy and sell their own bonds on the bond exchange. And BTCpop offers a unique feature called ongoing bonds with bond option number 2. Meaning as long as mandatory dividend payments are being made, the principal can be paid back as far in the future as the borrower wishes. Altogether, BTCpop's peer-to-peer Bitcoin bonds create a win-win situation for both borrowers and investors. And it just goes to show another great example of how BTCpop.co and Bitcoin enable the free market to benefit all. So if you want to issue your own peer-to-peer bonds, head on over to BTCpop.co today and sign up.